a housing bubble on the horizon for 2024.
I'm Michael Paluska. After the Great Recession of 2008 and 2009, many people might be wondering if we're currently inside another housing bubble just waiting for it to pop.
Right now, we've seen one of the strongest markets for new construction that I've seen in my career.
The housing market is teetering on the edge, and the signs of a catastrophic crash are becoming more evident. In the first quarter of 2024, the Case-Shiller Index revealed a 4% decline in home prices. Why is this happening, and how will it impact you? In this video, we're going into the disturbing details of the 2024 housing crash. We'll examine the latest data, compare it to historical trends, and explore the underlying factors that could lead to one of the most significant housing market meltdowns in recent history. Stay with me as we uncover the mechanics behind this potential crash and reveal critical insights that every homeowner and investor needs to know. By the end, you'll know how to navigate these turbulent times and protect your assets. So let's get right into it. As we approach mid-2024, the housing market is showing troubling signs. Despite a small uptick in prices earlier this year, the overall trend is alarming. The Case-Shiller Index, a key measure of housing prices, has shown a decline for several consecutive months. This isn't just a minor dip, it's a signal of deeper issues brewing beneath the surface. The Case-Shiller Index, which tracks changes in the value of residential real estate, has revealed a worrying problem. Home prices have been sliding for 5 months straight, with a cumulative drop of 4% in the first quarter alone. This is significant because it contrasts sharply with the previous years of rapid price growth. From 2020 to 2022, home prices soared by 43%, a trend fueled by historically low interest rates and high demand during the pandemic. However, the current reversal is a stark reminder that such exponential growth is unsustainable. The housing market is also grappling with increased inventory. After a period of tight supply, more homes are now available for sale. Builders, who had ramped up construction to meet soaring demand, are now struggling to sell their newly completed projects. This increase in supply, coupled with decreasing demand due to higher mortgage rates, is creating a perfect storm for declining prices. In addition, economic uncertainty is casting a shadow over the market. With inflation concerns and a potential recession on the horizon, consumer confidence has taken a hit. Prospective buyers are weary of making large financial commitments, leading to a slowdown in home purchases. This reluctance to buy is further adding to the imbalance between supply and demand, driving prices down even further. Now let's explore the specific factors driving this decline and why experts believe we're on the brink of a major crash. Several key factors are contributing to the current decline in home prices. Firstly, interest rates have risen sharply as the Federal Reserve attempts to curb inflation. Higher mortgage rates means fewer buyers can afford to purchase homes, leading to a decrease in demand. Interest rates have a profound impact on the housing market. When the Federal Reserve raises rates to combat inflation, borrowing costs for mortgages increases. In 2023, the average mortgage rate rose from 3% to 6%, effectively doubling the monthly mortgage payment for many buyers. This significant rise in borrowing costs has priced many potential buyers out of the market, leading to a noticeable drop in demand. Secondly, there's been a significant increase in housing supply. Builders who were previously ramping up production to meet high demand are now finding themselves with excess inventory. This surplus is driving prices down as builders offer significant discounts and incentives to attract buyers. Builders play a main role in the housing market's dynamics. In response to the pandemic-driven demand surge, the construction of new homes skyrocketed. However, with demand now cooling off, these builders are left with a glut of unsold properties. To move this inventory, they're slashing prices and offering perks such as mortgage rate buydowns and free upgrades. These incentives are aimed at enticing buyers, but also put downward pressure on home prices across the board. Lastly, economic uncertainty is playing a major role. With concerns about a potential recession, many prospective buyers are holding off on making significant financial commitments, further dampening demand. The broader economic environment is another critical factor. Inflation has eroded purchasing power, and fears of a recession have made consumers more cautious. According to recent data, The inflation rate reached 5.4% in April 2024, significantly higher than the Federal Reserve's target of 2%. This high inflation rate has reduced disposable income, making it harder for people to save for down payments and manage monthly mortgage payments. Additionally, the unemployment rate, while still relatively low at 4.2%, has shown signs of potential increases, further adding to the economic anxiety. In January 2024, for example, job growth slowed to its weakest pace in 2 years. This climate of uncertainty is causing potential buyers to hesitate, reducing the number of transactions and contributing to the overall market slowdown. But how does this compare to the housing crash of 2008? The housing crash of 2008 was devastating, with home prices plummeting and foreclosures skyrocketing. While there are similarities between then and now, such as rising interest rates and economic uncertainty, there are also critical differences. In 2008, the crash was primarily driven by subprime mortgage lending and speculative investments. Today, the situation is more complex. We're not seeing the same level of risky lending practices, but the combination of high home prices, rising interest rates, and economic instability is creating a perfect storm. The 2008 housing crisis was fueled by an abundance of subprime mortgages, loans that were given to borrowers with poor credit histories. These high-risk loans were often bundled into mortgage-backed securities and then sold to investors. When borrowers began defaulting en masse, it triggered a financial crisis that led to a severe housing market collapse. Banks faced massive losses, leading to a credit crunch that further exacerbated the downturn. Today's scenario, while not driven by subprime lending, is marked by other forms of financial stress. The rapid increase in home prices over the past few years has outpaced wage growth, making homeownership less affordable for many. Combined with rising interest rates, the burden on home buyers has increased significantly. Unlike 2008, where the problem was reckless lending, the current issues stem from affordability and economic pressures. Additionally, the speed at which prices are declining is noteworthy. While the 2008 crash took years to fully unfold, the current market is showing signs of rapid deterioration, which could lead to a quicker and potentially more severe downturn. The decline in home prices today is happening at a much faster pace. In just 5 months, we've seen a 4% drop, compared to the more gradual declines observed in the early stages of the 2008 crash. This rapid decline suggests that the market correction might be swifter and more pronounced, potentially leading to more severe economic consequences. But what's the impact on homeowners and potential buyers? How can you protect yourself during this volatile period? For current homeowners, the prospect of declining home value is concerning. If you purchased a home at the peak of the market, you might find yourself in a situation where your home is worth less than your mortgage, leading to negative equity. Negative equity, or being underwater, occurs when the outstanding balance on a mortgage exceeds the current value of the property. This scenario can be financially crippling for homeowners, as it limits their ability to sell the property without incurring significant losses. Those who bought homes during the peak price period of 2020 to 2022 are particularly vulnerable, as they face the dual pressures of falling home values and rising interest rates. For potential buyers, this could be an opportunity, but it comes with risks. Falling prices might make homes more affordable, but the economic uncertainty means it's a must to proceed with caution. It's essential to secure a stable interest rate and ensure you're not overextending financially. Potential buyers might see the current market conditions as a chance to enter the housing market at lower prices. However, this opportunity comes with substantial risks. Economic instability could lead to job losses or reduced income, making it difficult to keep up with mortgage payments. Now let's discuss strategies to navigate the housing market during this crash and safeguard your investments. Navigating the housing market during a crash requires strategic planning and foresight. One of the most effective strategies is to diversify your investments. By spreading your money across different asset classes, such as stocks, bonds, and real estate, you can mitigate risk. This approach ensures that your overall wealth is not overly exposed to the volatility of any single market. Diversification acts as a cushion, reducing the impact of a downturn in the housing market on your financial portfolio. Securing a fixed-rate mortgage is another important strategy. If you are in the process of buying a home, opting for a fixed-rate mortgage can provide stability and predictability in your monthly payments. Unlike adjustable-rate mortgages, which can increase over time, a fixed-rate mortgage locks in your interest rate for the duration of the loan. This protection is especially important in an environment where interest rates are rising, as it shields you from future rate increases that could make your mortgage payments unaffordable. Staying informed about market trends and economic indicators is essential for making sound investment decisions. Regularly reviewing reports from trusted sources, such as the Federal Reserve, the Case-Shiller Index, and economic forecasts, can provide valuable insights into the current market conditions. Being well informed allows you to anticipate changes and adjust your investment strategy accordingly. Knowledge is power, and in a volatile market, staying updated can make a significant difference in protecting your investments. Considering renting instead of buying may also be a wise decision in a volatile market. Renting provides flexibility and reduces financial risk, as renters are not exposed to potential declines in property values. This approach allows you to wait out the market turbulence and potentially buy a home when conditions are more favorable. It can be a safer option until the housing market stabilizes. The housing market is at a critical juncture, and understanding the factors at play can help you make informed decisions. Are you prepared for the potential fallout from the 2024 housing crash? What steps will you take to protect your financial future? I'm curious to know in the comments how the housing market is affecting you.